All right, let's talk Hims and Hers. They just dropped their Q4 2025 numbers, and wow, the market's reaction was interesting to say the least. It was pretty immediate and, frankly, a little confusing. So in this breakdown, we're going to unpack exactly what went down, what the execs had to say, and, most importantly, what this all means for the stock.
And boom, right out of the gate, the stock takes a hit, down almost 3% in after hours. Now look, that's not a total collapse, but it definitely makes you scratch your head. Why? Because on the surface, the numbers actually looked pretty decent. And that drop, that's the big mystery we need to solve today.
And right here, this is the core of the whole story this quarter. I mean, think about it. Hims and Hers beat what the analysts were expecting for profit. So you've got a win on the bottom line, but the stock goes down? That kind of disconnect is exactly what gets investors nervous. It tells you right away that the market looked past the big shiny headline number and found something lurking in the details that it really didn't like.
Okay, first things first, let's look at those headline numbers. The first thing everyone sees. And let me tell you, it was a really mixed bag.
So let's start with the good news, right? The company posted earnings of 8 cents a share. Now, Wall Street was only looking for 4 cents. That's not just a beat, that's a doubling of expectations, a really positive sign that, hey, these guys know how to manage their profits. You'd think this would be a slam dunk.
But then you flip the coin over. On revenue, the total amount of money coming in, they missed just by a little, about $1.4 million. And yeah, you might be thinking, that's a rounding error on over $600 million in sales. And you're not wrong. But in this market, a market that wants nothing less than perfection, any little whiff of slowing growth gets put under a microscope.
Okay, but this is where it gets really interesting. When you pop the hood and look at the engine, you start to see some real cracks. Gross margin, down from 77 to 72%. That means it's just costing them more to make their money. But the real jaw-dropper is free cash flow. This is the cash the business is actually generating. It went from a positive nearly $60 million last year to negative $2.6 million this quarter. That is a huge swing and a massive flashing red flag for any investor.
All right, so you've got these pretty concerning numbers in the background. What did management do? Well, they changed the subject. They basically pivoted away from the tough quarter and spent the entire call trying to sell Wall Street on their grand long-term story. And here's what that story looks like. They laid out these big growth pillars. First up, they're going global, starting with an acquisition of a company called Eucalyptus. Second, they're rolling out all these new services. Think at-home lab tests, hormone treatments, menopause support. And they're not thinking small here. They believe each one of these could be a $100 million plus business on its own. And third, and this is so important, they are desperately trying to convince everyone that they are not just the GLP-1 weight loss company.
And this quote from the call says it all. I mean, they hammered this point home again and again. It was like they were shouting, hey, most of our money comes from things that have nothing to do with weight loss. This is their big play to quiet down all the nervous investors who are worried about the regulations and the risks tied to those GLP-1 drugs. It's a classic, hey, look over here at all this other great stuff we're doing.
But it didn't work. Despite this big, bold, long-term vision, the stock still sold off. So what happened? Well, it all boiled down to one word: guidance. This is the company's forecast for the next quarter, and let's just say what they predicted was not what the street wanted to hear. Not even close.
And just look at the gap between what was expected and what they delivered. Wall Street was modeling for around $653 million in revenue next quarter. Hims and Hers came out and guided to a number that's about $40 million lower at the midpoint. Ouch. And the guidance for adjusted EBITDA, which is a really key profitability number everyone watches, was even worse. Their entire range was below what analysts were hoping for. That's how you create a major credibility problem.
Pros on Wall Street did not mince words. This quote from a Citi analyst calling the guidance particularly weak says it all. In analyst speak, that's pretty brutal. That's not them saying, oh, they missed by a little. That's them saying, wow, this is a real problem, and we have to completely rethink our assumptions about this company.
So what was the company's excuse? Or their rationale, I should say. They blamed something they called a shipping cadence headwind. I know, it's a mouthful. But what it boils down to is this. They say a change in how they ship their weight loss products is pushing about $65 million in revenue out of this quarter and into future ones. They swore up and down this is just a timing thing, not a demand thing. But you can bet the market is looking at that explanation with a whole lot of skepticism.
And this all leads us to the central question, the big debate for any investor looking at Hims right now. It's a classic battle. Do you bet on the long-term story management is selling? Or do you get bogged down in the here and now, scrutinizing these weak results and even weaker guidance?
And if you're wondering why investors are so tough on them, well, this chart tells you everything you need to know. The stock is down an absolutely staggering 78% over the last year. Meanwhile, the rest of the healthcare sector, it's up over 7%. When you've lost that much ground, investors just don't have any patience left for stories or excuses. They want to see results, period. So really, it all comes down to this classic Wall Street tug-of-war. On one side, you've got the bulls. They're buying the story, they believe in the international growth, the new product lines. On the other side, you've got the bears, and they're pointing to the weak guidance, the shrinking margins, and that big, scary regulatory question mark hanging over the weight loss drugs. And for now, let's be honest, the bears are definitely winning the argument.
So that's the whole picture, the good, the bad, and the ugly. The big question is, where does the stock go from here? Let's get to our final verdict, our rating and our outlook.
Okay, let's be fair. The long-term story they're pitching, it's actually really compelling. The idea of building this massive one-stop shop for consumer health, expanding globally, that's a powerful vision. And going after huge markets like menopause and lab testing, for sure, there is a real, legitimate long-term opportunity here. But, and this is a big but, getting from here to there is going to be a bumpy ride. You just can't ignore the short-term problems, the weak guidance, those shrinking margins, the fact that they're burning cash. Those are real issues. And that regulatory cloud over the weight loss business, it's not clearing up anytime soon.
So what's the bottom line? It's all about credibility. Right now, management is on the line. The market has put them on notice. It's officially in show-me mode. The story is great, but talk is cheap. Investors need to see the proof in the numbers. Until we see growth and margins pick back up, this stock is probably going to be stuck in the mud.
All right, so here is our official call for the next quarter, broken down into 3 parts. Step 1, our prediction. We think they'll hit their Q1 numbers. I mean, they set the bar so low, they'd better be able to clear it. Step 2, price action. We see the stock basically going nowhere, trading sideways, stuck in a range until that Q2 guidance comes out. That'll be the next big catalyst. And finally, step 3, our rating. Based on everything, we're calling this a market perform. The potential upside just seems balanced out by the very real risks right now.
And of course, we have to say it, this is for informational purposes only and is not financial advice.